Welcome everybody to Gust Presents, an introduction to and perspectives on the new Angel Capital Association model convertible note. We'll be diving into interesting history and evolution of early stage financing documents today. I think this is kind of the first big thing to come out since the YC Safe. So very excited today to have a great panel to talk through it, talk about when it's appropriate, why it's important, and what's going on in the early stage financing space. So we will start today with a little bit of an introduction, and then we'll move it into discussion and Q&A. And I'll let everybody introduce themselves first, starting with Dror Footer, partner at Ryan PC, member of the drafting committee for this document. Dror, tell us a little bit about your background, and thank you.
Great. Peter, thank you for having me. My name is Dror Footer. I'm a partner at Ramon Law. I've been at Ramon for about 8 years, but before that, I was the general counsel of a venture fund for about 10 years, and then the general counsel of a venture-backed company for about 3. So I've kind of sat on all sides of the table in these funding discussions. And I also, from a little bit after it was adopted, was part of the drafting committee of the NVCA model forms, the Series A forms, for about 15 years.
Awesome. Thank you so much for being here today. Very excited to go through this with you. Next up, we have Gil Silberman, Gust legal advisor, man of many talents. Gil, please intro yourself.
Okay, sure thing. Well, I'm a generalist too. I've been on, I think, all 4 sides of the startup funding equation as a founder, investor, both personally and with a fund, as an engineer, and as a lawyer who's represented a whole bunch of startups. Generally, what I think of as the 0 to 100 phase, from just before you're thinking of quitting your day job until around the Series A, Series B, 100 employees, when things aren't quite so fun anymore. So I've seen all these funding mechanisms from convertible notes and safes, and I'm very impressed and excited if we finally have a really good industrial quality standardized convertible note to take its place among the pantheon of acceptable industry adopted funding documents.
Awesome. Thanks for being here, Gil. And notably, as Gust legal advisor, Gil has helped us draft all of the interesting funding documents we use under Gust Launch, our company as a service platform. So very excited to have him here to share his perspective. And last but not least, Ryan, I'm going to skip you since we intro ourselves all the time. The illustrious David Rose dialing in from the back of a New York City taxi cab.
Hey, everybody. David S. Rose, founder of Gust, author of the book Angel Investing, and also the book The Startup Checklist. I've got about 120 companies in my personal portfolio, so I've invested on every possible conceivable set of documents over the last 20 years, the majority of which have actually been in convertible notes of one kind or another, where we have tried to solve some of these problems. And so I am delighted to see the new result from the ACA, and I'm looking forward to this discussion.
Awesome. Thank you, David. All right, so we're going to start off with a brief intro, kind of history of the evolution of early stage documents and how this one came about. Dror, I will kick it over to you for that, and we can go ahead and get started when you're ready.
Okay. In a second, hopefully this show.
And as Dror pulls this up, I will assure everybody we are recording this. We will distribute it after the fact. We will have time for Q&A and discussion later. So if you do have questions, comments, thoughts, please put them in the chat and in the Q&A.
Okay, hopefully you guys are seeing this.
We are.
Excellent. For a lawyer, I scored that as a high-tech achievement. Okay, so let me kind of, before I kind of walk through a little bit about the specific story about the process of how the Angel Capital Association approached it, give you kind of my personal intro into this subject. I was presenting last year at the Angel Capital Association's annual convention, and I was presenting, and from the audience, you could just feel kind of anger, if you will, about safes and frustration that the safes had kind of come to dominate the world. And my co-panelist, who was an angel investor, totally agreed with me, and then said, "That's why we use convertible notes." And I had to find a polite way of saying that's not really solving your problem, because conceptually, when you look at the structural differences between notes and safes, there are structural differences, but you shouldn't get a lot of, kind of security from them. So for example, yes, there is a maturity date, but good luck collecting on it. So, what I had to kind of politely say is that to the extent investors are getting kind of any leverage off of convertible notes, the action is really in side letters that sophisticated angels and angel groups tend to insist on as a condition of investment. And I approached the ACA and said, wouldn't it be great to have a standard note, and we could incorporate in it some of the best practices we see in side letters. And we're kind of in a really good time, because quite frankly, if we had introduced this thing in 2021, we would have been laughed out of the room because founders controlled the market. And clearly the pendulum has swung significantly, at least towards middle, if not more. So it seemed that if we were ever going to kind of make a dent in the safe culture, and if you look at Carta's numbers, I mean, safes are doing easily 80+%, maybe 85+% of pre-seed financing at this point. Right? If we were ever going to make a dent in it, this was the time. Okay, since I'm an attorney, you kind of knew this was coming. What I'm going to tell you today is not my firm's view. It's probably not my view. And if you do need an attorney, get a good one. And I will also add, it's also not the Angel Capital Association's view, even though I participated in the drafting group, and it turned out a really great attorney, Elizabeth Sigety of Fox Rothschild, had roughly the same insight at the same time and approached the ACA about doing the same exact thing. And we formed a committee of several other attorneys and several other heads of angel groups that set about kind of trying to create a model convertible note. And Elizabeth chaired the commission, and there's a lot of credit because she really was the lead draftsperson in this process. For those of you familiar with the NVCA process and the role that Sarah Reed played in it, this was very, very similar. Okay, so what were our goals? First, we wanted to create standardization. Interestingly enough, I mean, at this point, when you look at the NVCA documents, they're covering like 90+% of US priced equity. It didn't start that way. And in the pre-NVCA form era, it was 2003 that the first versions came out. In the pre-NVCA era, right, every law firm had its pet form of doing exactly the same thing, but doing it in a different way. And so you have to read every word of every document because there was no agreed upon standard. And if you ask Sarah Reed, why she pushed the NVCA initiative, it would be for the simple reason that she wanted to be able to do redlining against a template to see where the other side had made changes. And that sounds like a trivial benefit, but it's really actually huge in terms of transactional efficiency. And so basically you have this interesting world where preferred stock has the NVCA documents, Y Combinator drives every iteration of the safes, and it's kind of a free-for-all in convertible note land where everybody kind of does the same thing in a somewhat different way. And so our goal was to create kind of the convertible note mirror to those initiatives. We tried to present in a similar way to the NVCA in the sense that if you actually look at the way the NVCA documents are presented, there are kind of 3 tiers of clauses. There's kind of universally agreed standards. There are situations where there's a lead alternative and a very common second alternative, and then the NVCA forms typically have alternatives. And then there's a lead, but there are several, relatively common alternatives, and those get relegated to footnotes. And we tried to introduce that same kind of discipline to our drafting effort. Okay, the documents are available for free download on the ACA website. They've been doing some updating to their website, but as of 10 minutes ago, the links to the convertible note were on the front page of the website. we really want to promote that best practices. We added a model term sheet that I know Gil is a big fan of, and really our goal was to consolidate 3 documents into one. So the note does not require a purchase agreement. There's a single note document, and again, we were trying to negate the need for side letters and hopefully give founders an ability to say to those that typically insist on found letters, hey, look at our document. I think we've anticipated a lot of what you're looking for. We have kind of an info sheet that drives the note that has all the critical economic terms. In the forms, you'll see explanatory footnotes. We anticipate, just like the NBCA, continuously updating it. We have a little bit of market data included in the document and some of the footnotes. Our goal is actually to expand that very much like the NBCA has done with Omni. So how have we made this better? We have a significantly expanded set of reps and warranties. We have a built-in participation right. We again have select information rights. We have an optional most favored nations provision, board observer or board seat provisions. We have several protective provisions. And then we've also just, because it's necessary these days, added language for compliance with the CTA. And so we really tried hard to kind of balance investor friendliness versus founder interests, because again, we were very conscious of the fact, to be candid, that we were competing with the SAFE. And while investors have more leverage, it's not limitless. And so we really made a conscious effort to find things that were important to investors that didn't dramatically increase the burden on founders, and also didn't increase the transaction cost. So for example, if you look at our reps and warranties, they're pretty narrow. Most of these kinds of things are not going to be things that are going to require, a due diligence assembly effort that's going to require weeks. There, in a lot of cases, things founders should be able to handle off the top of their heads, and if they can't, that's probably a problem in and of itself. But really, we wanted to talk about, we wanted to get out a series of reps and warranties. Again, nobody's going to sue on reps and warranties in any of these investment documents in it, because you're damaging your own company. But the reality is, we wanted to force ventures to think about these issues, address these issues, review these issues with their attorneys, and make representations. And the other piece of the puzzle that we were trying to address, and why we think particularly the control provisions are fair in the current environment, if we kind of go back to the history of these documents, they were designed initially for short-term, to be out there for a short period of time and to have relatively limited amounts issued under them. And what we're finding now is you're literally looking at notes sometimes $4 or $5 million plus being out there 24 months plus. And it kind of, as a group, strikes us as odd that money would be in the hands of founders for that length of time, and essentially investors had zero control over what the company is doing. So we picked kind of really big ticket items for the protective provisions, but we think they're reasonable in light of how long these notes are staying out there and how much money is being invested under them. So that's my intro, and this is my contact information if anyone afterwards wants to ask me a question. And also I encourage you, I post a lot of venture content on LinkedIn, and you have my information there, and I assume we'll circulate this after the presentation.
Yeah, and I can vouch that information on LinkedIn is quite good. It is the reason that I reached out to Dror in the first place, not knowing he was in the midst of drafting a new model convertible note. All right, Dror, thank you so much for the intro. A couple questions, since I think we do have a founder-focused audience today too. If you could just talk a little bit about the SAFE itself versus the convertible note, and some of the founder friendliness angel investors see in that document, and maybe a little bit more on the specifics of the control provisions and reps and warranties and what those are from kind of a founder's perspective.
Sure. So I think from a friendliness perspective, it would kind of be hard to imagine a document more friendly than the safe. It's basically really pretty much no strings attached money. I mean, from a legal positioning perspective, not 100% clear, and courts really haven't dug into these and addressed them, but you're probably dealing with a prepaid option. So you're not sitting on the cap table as the investor. So essentially the founders have no fiduciary obligations to you until the point where it converts. On the convertible note side, theoretically you're a debtor, but the reality is there's rarely any meat on the bones, and your rights only kick in when a company enters the zone of solvency, because until that point, in a zone of insolvency, because until that point, the company is obligated to manage the company for the shareholders. The holders of the convertible notes are not shareholders, and only if the company really gets into trouble do these rights of a creditor kick in. And by that point, there's nothing to fight over. So, founder investors or angel investors and early stage investors are looking at this and going, this is string-free money. And we had a market through the late 2000s, through the teens, that it got progressively more founder friendly, and there was no real leverage in the competition for the right to invest to serve as a counterbalance to that. And so the first Y Combinator safes were in, I think, 2012. The updated 2.0 version, the post-money safes, were in, I think, 2017, and they were largely issued because it wasn't a one-time affair. It became common for multiple rounds of safes, convertible notes, and investors, it became impossible to figure out what the conversion math was going to look like. So they basically, Y Combinator came up with the post-money safe and said, we don't care what you've done behind the curtain. At the end of the day, when the dust settles for my investment, I'm going to get X% for a cap-based deal. So that was kind of the history of the safe, and it started as West Coast phenomena and picked up steam, so that in the height, 2021, there was, you probably saw a little bit more West Coast activity, but not a meaningful difference, and it's really kind of well on its way at this point. If there's no lack of alternative, it's really kind of well on its way to being the only game in town.
Awesome. Thanks so much. Gil, I think that's a good segue. Would love to get your perspective on some of this. Obviously you've written 2 excellent blog posts and very entertaining blog posts on the topic, which we are reposting on the Gust blog, but I think you can also link in the chat. But just some perspective from your angle on this. What are the good things? When is the optimal area you see? And what were kind of your reactions and thoughts to this as you're reading through it?
Okay, well, so first, let me put on my founder hat. My investor hat is a Mark Cuban baseball cap, but this is my founder hat. I've got a pretty contrarian, maverick kind of way of looking at these things, and pretty opinionated. Maybe not as opinionated as David S. Rose sometimes, but I tell investors sometimes just to pipe down. For one important reason, or 2 at least. One is, if you are not a full-time serious professional investor, if you're putting $5, $10, $20, even $50,000 into a startup from time to time, that doesn't buy you a voice to tell the company what to do. If the company, unless you're some expert or a valued advisor, most of the time there's a lead investor who takes this on. And so your choice is either to invest or not. And if you are to say, I do not like safe notes, I will avoid these at all costs, then you are saying no to 80% or more of all of the Silicon Valley major startup hub deals. And if you're a startup and you have that money available, unless you have this prized investor you are seeking, there may be no reason to concede that. And, in my experience on all sides of the table, hundreds of deals, I don't think I've ever seen a case where it would have made any difference in the outcome whether you used a convertible note, a safe, or even a priced round. Because at the end of the day, either the company fails and you don't get any money back, or you get a few pennies when they liquidate, or the company succeeds, it converts, and you're an owner. But as a small early investor, you're kind of out of the room at that point. And 4, 5, 10, 20 years later, sometimes you say, hey, congratulations, we're going public. Here's your $1 million or $5,000 or $10 million, as the case may be. And it's kind of a roll of the dice. So in real practical applications for most people, it doesn't make a heck of a lot of difference. And that 80% is not sorting out for the good companies or bad companies. I make an argument in one of my blog posts that it sorts out for founders who are weak and can be cowered into accepting position. Okay. And so I do have a few bones to pick, which we don't have time for, about the specific terms. But what I can say is that the value of this note in terms of standardizing and also just being extremely well written more than outweighs whatever discussion points you might have. It's almost as if you're going into a new country and you're on the road, and there's one country where there aren't any cops and you can do whatever you want, but the roads are mayhem. And the other, the signs clearly tell you what you can and should do, and they're well written, it's well regulated. This note is like that. It really has ironed out dozens of years of just accumulated, the wrong word, oversight, but for not overseeing things and bad language. And just to pick a random case in point, the note has introduced a common concept in law called the requisite holders. So whenever it's time to make a decision on whether we will allow the company to do something or not, or if the maturity date has passed, are we going to call the notes or not? Can we extend the notes if you need to raise more money? That decision goes to a concept called the requisite holders. And that is defined as a percentage. I might define it a little different to perhaps include specifically a lead investor, but there's a way to do that. Whereas traditional notes, they just say this note won't be amended or extended. And if you have 10 investors, you have to chase all of them down to get a vote, and it just doesn't happen. So the old versions of these notes are just broken. You cannot follow them. They do not work. So when it comes time to converting the note, even figuring out how much stock each person gets, the note has a concept that the preferred financing, the qualifying financing is deemed to have happened, deemed to have occurred on the date where the company gets the amount of money that triggers the conversion. In most standard notes, it doesn't say how you calculate. It says if you raise enough money. And so you're sitting there as a lawyer or founder saying, how many shares does each person get? And you kind of think, well, why don't we stop the interest on August 1st? Because that's when we signed the term sheet. And then you tell people, here's your shares. All these technical details are ironed out. And because of the standardization, you don't necessarily need to hire a law firm partner at $500 or $1,000 an hour to read every note, or to read the note, and their associates will compare and see if anyone got a side letter term sheet. And it's all locked in. So I really greatly admire that and think that I still have a few nits, but this is version 1.0. And I hope that as people start using this notes and maybe encounter a glitch or something like, this didn't work for me, they will just accumulate some experience, and maybe version 1.1, might address a few things that happen. So I'll wrap up soon, but back to one of the original questions, when to use it. I think if you are a founder and either there is no lead investor and you're dealing with, experienced Silicon Valley types, or there's a lead investor who is okay with a safe, by all means use a safe. They're faster. They often are done without lawyers, although I would say every company and every financing should have a lawyer, but they don't require intense legal work. This note still takes some legal work. I would beg to differ about the reps and warranties. That's a whole discussion. When you are asked to represent, for example, that you have complied with all the security laws, or that you have never granted an IP license, it's good discipline to take that seriously, even if, as Dror rightly points out, these things don't end up in lawsuit. These are exercises. But this discipline of going through reps and warranties is really good for the company. So if you're in sort of a middle ground where the investor is asking for it, it's certainly reasonable to use a convertible note, or even, heaven forbid, the NVCA preferred financing documents. But in one of my posts, I put kind of a path to your Series A, bigger company venture round. And I would say up to maybe $500,000 or $1 million, safes are probably the way to go, because they are small amounts of money. They're fast, they close quickly, they don't require a lot of work. Above maybe $2 to $4 million, and this aligns with Carta's studies. Safe rounds are protective of the investor, and when investors putting in $2, $4, $5 million, they buy a seat at the table, and they really have a lot of money they're watching out for, probably other people's money. They have a good reason. So in between, there was a lot of, should we have a price round? Should we have a safe? Should we have a note? I think this note covers that middle ground. So whether you put it at $500,000 to $5 or $2 to $4 million, it's a good solid instrument in the middle. So that's my general take on it. I'm looking forward to seeing how this works out in practice.
Appreciate it. I think it's a good segue. It touches on a question from Benjamin David Novak in the chat. Benjamin, thanks for joining us. And also touches on some of your philosophy, David. And I think one of the key questions here is like, okay, why do angels want convertible notes? Why do angels on the East Coast want convertible notes? And, David says in the chat, or Benjamin David Novak says in the chat, what about when the company doesn't blow up, right? What about if it turns into a lifestyle business? What are the differences in investment philosophy that might actually cause an investor to choose one or the other and have it materially affect the finances?
So I come into this with a different perspective than my two esteemed colleagues on the panel here. They are both lawyers who have been drafting these things forever. I am a serial entrepreneur turned serial angel investor who has been using these things on one or both sides for over a quarter of a century at this point. So as a founder, having founded over half a dozen companies, as an investor, having invested in 120 companies, of which I've led quite a few of them, I have, as Pete pointed out, typically strong feelings on a number of subjects. And so originally, when I first got into this business, doing an angel deal, it was totally Wild West. There was no industry. Nobody had ever heard the term angel. They barely heard the term entrepreneur. And so if you wanted to invest in a startup company, you would go hire a lawyer. You spend $50,000 or whatever, as if you were lucky, on a whole custom set of documents. And clearly that made it was really, really tough. After the dot-com crash and in the early days of the 2000s, when the angels were the only people writing checks, and that's when the Kauffman Foundation decided, which is a whole foundation supporting entrepreneurship, decided the best thing they could do was to get companies funded. And since VCs weren't writing checks, they created the Angel Capital Association by manhandling all of the existing angel groups into a room and saying, hey guys, figure something out, right? And that was also the time that the NVCA, that period, created the model docs, that drawers on the team that did that, as were a whole bunch of lawyers we respect. And so then, as angels began to get more organized with the founding of the ACA around 2004, 2005, which, by the way, is when Gust was founded, a little before that. And so, at that point, I was doing 10 deals a year. And an active angel and an active angel group, Angels said, whoa, the whole world is completely, we don't have anything like the structure those VC guys have. And so the ACA tried to do best practices, but it wasn't anywhere near like drafting documents. And so we tried to adopt the VC's docs. And so for the first, 5+ years, maybe even 10 years of my angel career, we would do a priced round using the same docs that VCs did, trying to make it a little more rational, but we knew that you could just adjust the price, but that was the docs you wanted. Then YC came along in this boom period where YC companies were getting all kinds of rock star status and threw a monkey wrench into the machinery, or at least reset the game by coming out with the safe. And the safe came out just about the same time as my book on angel investing, which is now what, 12 years ago, something like that. All of a sudden, because YC had the power and their companies had the power to pull that out, as Dror said, all of a sudden the power went to the hands of these hotshot startups who were saying, hey, here's my deal, doing it on a safe. Now, I, along with every other investor and every other investor's attorney, like Dror and Gil, looked at this thing and said, "Holy shit! This safe! I mean, talk about company friendly. This isn't the discussion. What's a little more friendly? This is like taking the entire 110 pages of the NVCA, price documents and throwing it out the window, taking every possible, protective provision in a convertible note and throwing it out the window, and basically saying, hey, yeah, you can have some part of my company in the future if and when I let it, and in the meantime, you're not going to accrue interest and you're not going to have any rights. And if it goes under, you can't do anything about it and you got no voice." So basically, I would say most active angel investors and most active angel groups, including New York Angels, which I founded, simply refused to do deals on safes. We would, so if we weren't going to do a deal on a safe and rationally recognizing that a full NVCA series thing didn't work, what were we going to do? Well, there were two approaches, one of which was Ted Wang came out with, I think of Fenwick and West, came out with a Series Seed set of priced round docs for that were also first round capital did the same thing about that time. And so that was taking the NVCA's convertible preferred stock round and taking out 90% of the stuff that you couldn't do, like gap stuff and all the securities things for when you go public, and basically saying, this is a first round, easy round. And if and when somebody else comes in afterwards with a VC with a full Series A docs, then we get all those rights as well. So that was one approach. But the other approach was to use a convertible note. So we'd have our attorneys draft a convertible note, which let us put cash in. It let us put in whatever provisions we needed, including pro ratas and so on and so forth. And it ensured that there was a timeline on it, because it was supposed to be a short-term thing. If you were going to do a longer-term deal, then you should have a priced round. This was a 12 or 18-month max note to cover you to your next round. And so we did convertible notes. And then that was great. And we did it. I would say most of the deals that we did at that point were either priced rounds or convertible notes, most of the deals that I was in. And then a very interesting thing happened. We did one deal that actually turned out to be a pretty good deal. And it actually got a big acquisition by Amazon, as a matter of fact. And we went to the closing and we did all this kind of stuff. And it turned out that, people had written the convertible note saying you will in the next round get the same thing as the people, as your convertible note holder, you get the same deal as the next round, and your preferences, 1x and so on and so forth. It so happened that this deal had a funky history where it had done a low priced round, convertible note, a much higher one, a lower one, and then it finally got acquired. So when we went to do the closing, looking at the terms of the notes we had invested in, it turned out that one tranche of people got the same exact deal that the VCs got in terms of the 1x preference, and other people got completely teeny weeny little things screwed in there, and we had an outcome that didn't work. It was a bizarre outcome. So in the same exact deal, some angels made bank and some angels got nothing. And we looked at it and said, oh, Jesus Christ, there's a problem with these docs. So we then spent a lot of time and effort drafting what we thought would be hopefully a standard convertible note. So New York Angels did that. Gust got involved with that. And that's something that I've used for probably the last 5 to 10 years, since I try not to do safes. And it was a more standardized convertible note. And so I was a little curious to see the ACA's version, to see if it had fixed this loophole that was a problem that we had solved, and it was improving on what we did. And like Gil, I was both skeptical that they could do it, knowing how committees work, and B, really surprisingly pleased by seeing what they had. And so it solved that problem, by the way, which means you're effectively creating a shadow stock, shadow class of stock in the new one, because to get the the price of the conversion price the same, and it solves all the other pro rata things, and it gives you all the various options of stuff that angels and VCs were putting in. So on that sense, I'm with Gil, and congratulations, Roy. You guys did a great job. Liz Siggety and a bunch of you, it's really good, and absolutely, we are going to bring it onto the Gust platform as is, and then let people do that on there. Now, that's the background. To answer the question,
I was going to say, you didn't answer the question yet, David.
I got there. To answer, all these things about being tight and short. It was all aimed at me, by the way, since our two panelists are lawyers and they speak concisely. So to answer the question about when would you use what, right? As I wrote, what I wrote in my book, both the Startup Checklist and Angel Investing, about when to use what, still actually holds, right? And that is, it's been slightly pushed by the market because of the dominance of YC safes and the way that they have been taken over the market, but the thesis still works, right? And by the way, the YC safe has changed dramatically over time. So they've kept adding, YC has put in more and more stuff. The original YC safe was like a page and a half or 2 pages of something and had virtually nothing. They've added and overloaded it with a whole lot of stuff. So now it looks sort of like a convertible note. But that being said, a safe is appropriate without evaluation when you are, as a first-time entrepreneur, are hopeful but don't really know what you're doing, really can't price it. Few entrepreneurs can price their own deals appropriately, and you're dealing with friends and family or novice angels or people who really, as Gil said, don't have the knowledge, the power, the background, the check size to be able to put in demands. And so effectively, if you as the startup are running things, you don't want to price it. You let the next round effectively price it. And the goal is to let people get their money in painlessly and move into the next round. And that works for people who are not professional investors, and that's when you should do it. So a friends and family round, realistically, without a big lead, should be done on a safe. If you are coming in with a $5 million, and by the way, the price of seeds and the amount you're raising has gone up. So a typical seed round now might be 5 million. That would have been a Series B, when I started out. But so if you're doing a $5 million round, that should be a price friggin' equity round with the full-on series of docs and all of the things are pertinent there too. So the question then happens, what do you do north of a friends and family round and south of a price round? And that's where convertible notes have played, should play, and where this is a godsend and is a great thing to do, because this lets you have a standardized thing that protect angels without letting them get completely screwed, but at the same time protects the company, lets everybody know, given the provisions and all the alternatives that was put in there, exactly what the normal things are. And then when you see that this is a standardized deal, as Gil said, you can adjust the price up and down, and there's a conversion price to it. So to answer your question, the bottom line is use a safe if you're dealing with unsophisticated investors. For small amounts, use the ACA convertible note, soon to be appearing on Gust. If you are doing a professional angel rounds with angel groups, rounds with angels who insist on using a convertible note, rounds with really smart leads in there, for any, I would frankly do it for anything north of $500,000. And so given the existence of this ACA note, I will not do safes. I will now push them to do a deal on these kinds of terms. And so that's great up to probably, if you're getting to 5 million or so, where you're now to carry the company for multiple years to your next big value thing, that really should be a price round and should be using either a version of a series seed, such as the Gust series seed version, which is really quite good, or the Fenwick and West one, or ultimately is a series A, a NBCA model dot one. But the bottom line is angels now, I think, should rally behind this immediately and standardize on this thing. There will be a couple of tweaks, as Gil pointed out. I've got a couple of little comments here and there. I think the term sheet needs to be, we need to do an annotated version of the term sheet. I think clean it up and annotate it the way we've done with the Gust Series Seed. But ultimately, lots and lots of kudos to the ACA. Best thing the ACA has done probably in 5 or 10 years. And congratulations to Dror and Liz. And Gil, I loved your blog post on the subject.
David, that was quite good, but you still didn't get to the root of my question.
Okay.
From an angel economic standpoint, right? When Gil's talking about why choosing a safe or convertible note doesn't matter materially. If we look at that from the VC perspective, that is because it is, rocket ship or zero, right? But if we think about the Moneyball approach,
Sure.
when does the convertible note actually play into the economics of the investor?
The answer is the convertible note plays into the economics of a deal compared to a safe when you don't, when you can't pay it back, right? And so what happens when you come to the maturity date? The reason that angels and we did convertible notes as opposed to safes is that with a safe, you basically are saying, take my money, and whenever you come back, and I have nothing to say, no leverage, no nothing over time. The convertible note gave you a maturity date at the end of which, hopefully, if you had done it correctly, it was well past when the company thought it would do another round, and you'd give them all the, the rope they needed to hang themselves or to get to a next round. But then if they didn't do it at that point, then you could have a serious talk, and the maturity date where it had to be paid back, but where there's no way the company could do it, would give you at least leverage. And I have, despite all of the things about vulture capitalists and evil angels and devils and so on, every angel that I've ever invested with has been a decent person. And the goal is to say, okay, how do we solve it now that I have the leverage? My father taught me growing up, have ironclad contracts and then put them in the drawer and forget about them and do the right thing, right? And that's what you get with a convertible note. If the ironclad contract says, when this note is due, you got to pay it back, right? If you haven't done your round. And if the company has not done its round, it can't pay it back. So now what happens? Well, in theory, the angel could foreclose on the note and take the company, but nobody's ever going to do that. I don't think it's ever happened. And so what it does, the threat of that, the possibility of that means that the angels now have the right to a conversation. And then they will typically do the right thing by extending the note or whatever. You don't have that with a safe. And I, as an angel, an elite angel, and a knowledgeable angel, do not want to just give my money to a company and have no further discussions with them. If a company is not able, if we did an appropriate convertible note with or a safe with an appropriate, time frame, 18 months, which is, a year past when they think they would get their next round, and because they'd have all these kinds of things, you get to that point and they haven't done a round, they need cash and they haven't the ability to pay it off. We should have a discussion and let's talk about what we're doing. And that's what that did. And so therefore the economic effect of that is to give you the right to have that discussion.
Awesome. And I think worth pointing out too, and Jordan, maybe you can comment on this, but angels are often investing with a thesis, as David calls, a Moneyball approach, right? So this thing may not be a unicorn $1 billion. It may end up at $100 million, and that may still be a good exit. David or Benjamin David Novak in the chat mentions, okay, if you invest in a startup with an intention to be a startup, and that startup turns into a growing business that is growing linearly.
The answer is that is a case that is not solved by any of these three things. It's not solved by a safe, it's not solved by a Model A, a series MPCA doc, and it's not solved by a note. It is solved by the fourth thing that we haven't discussed here, which is what Indie VC worked out a number of years ago, and I've been trying to get Gust to do for a while, and we may eventually get there, which is a financing doc that sort of works like a note. If it's a converts, it sort of works like a price round if the deal converts into, if you have an acquisition, and if it doesn't, if it turns into a lifestyle company, it provides a vehicle there, and that vehicle is a really smart one. Basically says, okay, we're the investors, and you're not going to do another round. You're not going to be a unicorn. You've given up that dream. You're now running as a successful business. And you know what? If you ultimately, as the founder, decide to take out cash from the business because it's got to be a decent lifestyle business, but not a home run, then fine, you can decide when you take out cash. But we, the investors, get a 4-to-1 ratio, 80-20 of whatever you're taking out until we get back our investment plus whatever, right? After which we flip it, and then you get 80% of anything you take out, and we get a residual 20% for the life of the company. And so that kind of structure works really well for a lifestyle company, but it is not treated by any of these four things.
Dror, as a person who sat on the drafting committee, was that a consideration? Was that company trajectory a consideration? And do you see any actual provisions of the note or structure in the note to accommodate for that?
So, I mean, I'd like to claim total brilliance here, but we didn't specifically discuss that scenario, but we are covered because one of the protective provisions we have in the note is actually approval of dividends. So, you know, if this note stays out there unconverted for a long period of time, you know, the founder is gonna find a tough time getting the money out by way of a dividend. Can they play games on comp? Possibly, but they're not going to be able to do that. By the way, David, thank you for raising the Fenwick form on the Series Seed. That's been like one of the depressing things to see is that, you know, that form has almost disappeared. I mean, I saw it about 3 months ago, and I was like, I almost had tears in my eyes because basically now you just see the NVCA forms with global search and replace on you know, Series A to Series Seed. And I thought that was a really effective form.
So I actually draw, I don't know if you've seen our version of it, that was a combination of me, Gil, and Laurie Smith, who was actually on the NVCA committee back in the day. It's actually on our website. If you want to post a link to it, Ryan, or you put a link in there, right? Ryan just put a link in there. Take a look at that. It's actually our attempt to do a slightly better, cleaner version of the Fenwick and West Series Seed, and I did a term sheet for it with full annotation, which I think is really interesting, that walks everybody on both sides through, you know, how and why and what the thinking is. And so you might actually like that as a potential alternative to the Model A.
Yeah, no, listen, the problem is the efficiency of adoption, right? Because like I said, we're using common forms. It just drives it. Even the NVCA forms are not models of easy use, but they're now a defined standard. And so that's a big step up in efficiency. I mean, I think, you know, I think the fundamental issue behind all these documents, you know, because the arguments for both safes and convertible notes are speed and low cost. The reality is document generation at this point is not the major driver of expense, right? I mean, particularly in the early stage, it's kind of the cleanup you need to survive diligence and make reps. And in the later stage, the sheer volume of information you need to review to make reps. So I think from the investor perspective, right, it's how much do you want to know about this company as a condition of your investment? That, you know, my experience is really the major cost driver. And obviously, what you want to know and how much you're willing to spend to know it increases with the size of the investment, and the difficulty of the company to produce that increases with the size of the company. So this is kind of a scaling process. You know, I think that the Series Seed, again, if it's converting into a priced round, you know, 6 months or 12 months, and there are going to be reps and warranties there, so the company is going to pretty quickly be forced to own up to these things, great. I think the big factor is just the length of time these are out there, and now you have the phenomenon of stacked safes, stacked convertible notes, mixed safes and stacked notes. You know, it just creates a long period of time before a company goes through the scrutiny that typically accompanies its first price round.
Which, by the way, is why credit to the Gust team, and I think Gil for thinking of this originally and us for implementing it. The Gust stack of docs, which starts out with a safe, you can, you know, if you follow my thesis of you do a friends and family round in a safe, and then when you get a serious angel in, you do a note. Instead of having a stack thing, it automatically rolls up into it, maintaining the right terms, and they're all designed to comply with each other. So you can roll the whole stack up. Whenever you get a more professional player in establishing a thing, it takes the previous stuff in, and that's actually, in an ideal world, I think the way all this stuff should work. But you might also want to take a look at Pete, send that to Dror as well, because that's a really interesting way, and it's worked very well.
And you have the law of unintended consequences when you use these things beyond their intended purpose. So, for example, a partner might came up to me, a company doing a C round, after having issued $10 million in safes, you know, to bridge to the C after the B. The C round did not trigger anti-dilution, but when you factored in the 20% discount, it did trigger anti-dilution for those safe holders, you know, who were now converting, and the math was a lot of fun. You know, that, I mean, that's, yeah, all of these instruments have purposes that where it's valid and the risk cost benefit makes sense. We've just kind of concluded, you know, 5, 6 years where we push these things well beyond their sensible use points.
All right. I think we have enough questions that we can start diving into those. And I think the first one is actually on the topic of stacked safes. Quite a bit has been answered in the chat, but if we can give quick coverage on kind of the dangers of using different instruments and what can happen, and then maybe a comment on not just stacking the notes themselves, but essentially stacking the amount of capital you're bringing in and pushing that out farther, and what perhaps unintended consequences it can have from the founder perspective in the age of post-money caps. I'll take volunteers on this one.
I mean, the biggest one, which unfortunately a lot of founders don't realize, and unfortunately in some ways it's less of a concern now in a down market, but essentially you are giving investors in a cap deal in a rising market full ratchet anti-dilution protection. The thing that you would, you know, just laugh an investor out of the room for if they ask for it in a priced equity deal. I mean, even in 2002, 2003, full ratchet rose to about 8-9% of all deals. It's not even 1% today in a similarly bad market. So I think a lot of founders don't understand conceptually what they're giving when they're agreeing to a cap, and they put infinitely less thought into the amount of the cap than they would in the valuation discussion for a priced round. The flip side of it is, and it's interesting, and I think it may reflect differences in the investment body. If you look at current CARTA data, the percentage of safes being done cap only has risen dramatically in the last 18 months, which in a down market makes absolutely no sense, because it suggests that more and more conversions are being done, you know, with no discount because it's under the cap. And so the investors are getting no reward. So there seems to be kind of almost a symmetry of lack of full appreciation, particularly in the safe population. And you don't see the same terms with convertible notes, though admittedly, you're dealing with a much smaller sample size with convertible notes because safes so dominate. So I think there are a lot of safe consequences that both sides of the table don't fully understand when they're signing on the dotted line.
So let me jump in here for a sec. And this is a thesis in terms of the Moneyball stuff that I wrote about in the book. That founders have to should think the way investors think, and investors should not be idiots. Investors should think about this rationally. VCs think about things usually rationally, right? And when you do a price round, you say, I am buying this amount of stock in the company at this valuation, so I have this percentage of ownership, and then I have some protective provisions, not going to be, you know, full ratchet if you can get it, but usually weighted average anti-dilution. And so therefore, if, you know, I am giving you this valuation because we both think the company, well, is worth this if you do what you say you're going to do. Well, you know what? If things turn out not the way you said you were going to do, and the next round when you raise money is not at an even higher valuation than I came in at, and it's at a lower valuation, then clearly we together were mistaken about what the valuation of the company was. And so therefore I sort of get a do-over, and I get some type of anti-dilution protection on my thing. This is triple in spades in the case of angel investing, right? And so what I have maintained from day one is that the valuation cap on an angel investment on a convertible note, the valuation cap equals the valuation that you would do an equity round at now. Because if it's different from that, if it's higher, why would you know, ultimately when the next round happens, why would the angel investor who took the risk early on when a VC wasn't taking that risk, why should he get penalized by coming in at a higher valuation that the VC is doing later on? That makes no sense, right? So therefore, the cap, which is, other people think it's crazy things, but in the real world, the cap is the valuation of your company now, and both sides have to look at it for that reason, which is why if you take the Moneyball approach, angels should be pretty damn serious about figuring out what that cap is.
To me,
Yeah,
cap
typically the
equals safe.
cap is too high, and a lot of notes will convert, and a lot of safes will convert under the cap, because in Silicon Valley, if you're starting a new company, you're thinking $5 million valuation cap. AI companies are going out at $10 million valuation cap, and the number that actually raised money quickly at a higher valuation is somewhat limited. So the discount becomes important, and for David's point, setting a realistic cap. On the other hand, if you take the law of averages and figure most companies fail, and so maybe $2 million is the right cap, that's going to cause structural problems. You can't raise $1 million on a $2 million cap, because now you're giving away a third of the company. So becomes
Yeah,
a bit
I mean,
tough.
if I were kind of king for the day, and this would be a sad commentary on my kingdom, I would actually ban caps, because to me, what actually makes the most sense and kind of aligns interests would be a time-based variable discount. So, because basically the notion should be, I'm rewarding you for taking the earlier risk than the people in the price bracket. And to have that be a static discount makes no sense, because it's very. It turns out I took a lot higher risk if it took you 24 months to raise the round of equity than if it took you 6 months. And so, to me, if you want to kind of align all incentives around the table, pick a discount rate that starts with a mild bonus to me for taking a limited risk, and then the longer my money's out there at risk, the longer it takes you to get your act together. I get rewarded for that.
But by the way, George, that is exactly the way the New York Angels current standard convertible note works. It has a declining or increasing discount based on timeout.
To me, the cap just it's particularly in early stage where you can't do discounted cash flows. You can't do real valuation in any meaningful way, right? So tying it to a cap is your guess is as good as mine, and I just think it isn't rational. I mean, I think a variable discount just aligns everybody.
Well, the one problem with that is you can't really predict the growth and the interest rate in the future. So that kind of becomes like a giant lion chasing you. I'm thinking of the old days when they used to have multiple liquidation preferences. Instead of 1x, it might be 1x if the funding is in 1 year, and 2x if it's in 2 years, and 3x. They don't do that anymore. But one of my early investments was OpenTable, and I think they took in like $40 million worth of liquidation preferences before the dot-com bubble burst. And it's like, no matter how successful it is, it's never going to pay back $40 million. So we all gave up on it. So sometimes those things, create this stack of either liquidation preference or valuation cap that can just become problematic. In fact, anything that you do that's trying to predict what's going to happen with the company and the market and the economy, more than 2 years out, more than 4 years out is, per one of the comments, it is gambling, but, so is the public market too. If you invest in Apple, you can't tell me that the price next week is not a gamble from your point of view.
No,
Awesome.
no
Thanks
question.
all.
But I think what you can shoot for are structures that align incentives, and so you don't want founders to kind of hold out because they think there's a better financing deal in the future because they're sitting on essentially, in a safe, free money. I mean, one of the interesting things, by the way, is as interest rates have risen, and the interest rates on even convertible notes now have become like 8%, and now they're sitting out there, 2+ years. Now you're talking about meaningful dilution. So like when I was counseling a client 2-3 years ago, safe versus note, I would say, listen, if you can get them to go for safe, great. But if they insist on a note, don't worry about the maturity date. Nobody's ever actually foreclosed on one of those. And the interest, as long as you have the money out for a relatively short period of time, it's not going to be meaningful in terms of dilution. And the combination of time and interest rates now, you're looking at 16, 20, 15, 20% added dilution, resulting, a safe versus a note issued on the same day, you have that 20% additional dilution because of the combination. There is a real difference.
Yeah, sometimes the interest can even predominate over the discount. as an investor, it's kind of a nice little bonus. If you invest and you say, oh, wow, there's another 25% interest, 25% more stock, that's great. But in a low interest environment, people take the interest term too seriously. In fact, that's kind of the mark of an investor who's used to investing in Main Street brick and mortar companies, that they're overly concerned with the interest. They say, look, I want 12% back. And they think that's how a convertible note should work, when that's not the deal. But that's a case in point, that when we go from essentially an almost 0% interest environment to an inflationary, I mean, you get 25% more, but there's been 10% inflation in the meanwhile, so everything's worth 10% less. So the precision over which you can predict things like return on investment and your portfolio value just diminishes as you look into the future, where we don't know if there's going to be another boom, or there will be another boom and another recession, but we just don't know when and where it will hit.
All right, we are cresting our time horizon here. We have a few more questions, so let's lightning round this, and I will try to pick the easy ones out first, and we can get through those quickly. First up for Dror, is there any provision in the model convertible note around auto conversion to common stock at any point? And I assume this is auto conversion without a vote, by nature of the use of the word auto?
Into common stock or stocks?
Into common stock.
Yeah, so I believe a qualified equity is defined as conversion into a preferred class of stock, and then obviously your vulnerability to a subsequent cram down would be subject to the terms of the priced equity.
Yeah, so just to be clear, no angel or investor would ever take common stock or do an instrument that converts into common stock. You're always going to convert into the preferred stock, which gives you your preference and protections and so on and so forth.
Yeah, and I believe the Gust convertible note essentially maps out using the Series C preferred stock template in case of that type of conversion. Okay. With a convertible note, don't you have to fix a valuation? With safes, a valuation was curtailed so that pre-seed, pre-revenue startups could be funded without it. No? Okay, so I think this is a question about whether or not a convertible note requires a valuation. It doesn't, but does it require a valuation cap?
So again, you have in safe world and potentially in this world, you have kind of all the different conversion options. So you can have conversion as a discount only, you can have conversion at a cap, which is what I believe the forms provide for, or you could have a best of formula. Y Combinator has it's interesting there. Y Combinator actually doesn't have one of its forms for the best of a discount or cap, and its third form is most favored nations only, which I used to be able to say until a week ago I'd never seen in the wild, and then I saw my first most favored nations only safe. So the shorter answer to your question is, depending on the conversion mechanism you pick and negotiate, you may or may not be required to set a valuation cap. In terms of convertible notes, based on Carta's data, and might reflect the higher sophistication, as opposed to safe world, which seems to be gravitating towards cap only, which doesn't make a great deal of sense for investors. The most popular choice in convertible note land is the best of, from an investor perspective, the discount or the cap.
Awesome, thank you. And yeah, just in brief, neither instrument requires a valuation cap, but the norm, especially at larger amounts of investment, has trended toward utilizing one on convertible notes in conjunction with a discount. Okay. Given 95% of startups fail, assuming one has taken in capital via an ACA model convertible note, what happens if they fail?
So, I mean, I can give you kind of the theoretical answer. The real answer is probably the note holder gets zero. But in theory, right, the note holder stands as an unsecured creditor of the venture, and will stand in line with the water cooler person and and the Xerox machine person with a claim. The reality is that most of these ventures, if they haven't converted, probably don't have enough assets to meaningfully pay, outstanding things that could get companies in trouble, like salaries and taxes, much less to have any money to distribute. And I believe the form provides that it's treated as if it were preferred equity, but you can't, so you can put yourself ahead of any common distributions by that, but you can't put yourself ahead of creditors, and most of these companies will not clear that hurdle. And one of the things you find out when companies are wind down is, for all the money, there is no correlation between the money you've invested in creating IP and its salvage value when it's being sold kind of on its own outside the setting of the company that birthed it and the personnel that knows how to deploy it. So assume unless you get pleasantly surprised that you'll see zero.
Well, I have had maybe 2 or 3 times in the last couple of years as an investor, I've had failing startups return some money. And it's always nice to lose half your money instead of all your money. It's kind of it's like, wow, yeah, I got half my money back. That's a lot better. I think that's more dependent on the founders and their relation maybe with the key investor and their advisors, whether they know when to throw in the towel and how responsible they are about that. And that's going to be more important, I think, than whatever form of instrument, except as noted, a note and perhaps a safe and a liquidation provisions will give you, in effect, a liquidation preference, because it would, in theory, convert to preferred stock or the equivalent, the financial equivalent before the liquidation. So it may be that you should be ahead in the line as compared with, the employees and founders, because, they put zero money in, you put money in, and now we're giving away 50 cents on the dollar. I think the people who put the money in should get the money first, but that seems to be the way that the instrument operates.
Yeah, but that being said, as Drew pointed out, I mean, I've got 120 companies, half of which have failed, probably something like that.
It's not 95%. It's not that bad. If the 95% is if you start the clock before you quit your day job. Most companies that fail before they even get started. They never launch a product. They never raise money.
So, but the odds of a company actually having enough to pay off, something, having cash left over if they've failed. I mean, there have been a very few cases where a founder saw the writing on the wall, after, one major, like a first product launch or something, or a show, and it was clear it wasn't going anywhere. And that founder rationally and fairly approaches the investors and says, okay, folks, this isn't working. I'm planning to do it. And they stop and they take back. If they had done a big round, they'd raised $2 million and they spent, $1 million and it's not working. They might say, okay, that's it. We're going to give you back the half of it. But other than that, and I maybe have had 1 out of 100. If the company is failing, it's failing. Everybody loses everything. And if it can pay off its bills, that would be regarded as a great success before you get to the investors.
Well, you and I are involved in one, I think, but it's not cash back. It's, an asset sale or a soft landing or a fire sale to a company that gives you a few shares, and hopefully that company has an exit. And sometimes that is still only cents on the dollar, but at least you get something back. So it is not unheard of that a company will liquidate in a managed asset sale. But you're right. You're right. That's definitely not what VCs are investing for. And in an angel portfolio, that's pretty rare that it makes much of a dent.
I would make 3 points. One, there is sometimes maybe I was too broad brushed. In life sciences, sometimes you actually do have real residual value, whereas in IT it tends to really be negligible. And two, if you may, as an investor, you actually probably don't want them to hold back unless it's really hopeless, because you're in it for the big return. Getting back 50 cents on the dollar isn't really going to change your return thing. If there's really a credible chance at something, you kind of do want them to run into fumes. That said, to David's point, if you do have a founder who comes to you and says, listen, I've run the numbers, there's no way this thing works, make sure to back them on their next venture. Because that is the kind of person, you want it back.
Yeah, that type of integrity is pretty amazing to see. All right, we are down to our last question. What is shadow stock? David, I think you mentioned this as you were walking through the convertible note, but I'm not going to let you answer it because we're over time. I'm going to kick it to Dror for concision.
Yeah, so when you have a conversion, right? When you look at the price to equity documents and you have things like calculating the liquidation preference, they're based on the price per share. And that's hardwired into the certificate of incorporation. And so if you do nothing, right, and let's say my shares are converting at a 20% discount, right, I'm going to get the full liquidation preference even though I paid 80 cents on the dollar for the shares. So what you'll do sometimes is create a shadow class that's identical to the parent class in every way, except for purposes of calculating things like the liquidation preference and anti-dilution protection, you will factor in the actual purchase price rather than the stock definition.
And this is the one thing I went right to that section when I looked at the doc saying, please, I hope you covered this. And they did. And so if you didn't have that provision in there, it can result in ridiculous consequences. Trust me, I know.
Awesome. Well, thank you all so much for being here. This has been really wonderful. I feel like all of your perspectives complemented each other extremely well. I learned a ton. I hope everybody else did too. Thank you all for joining us. This has been a presentation of Gust. We build stuff to make the early stage financing ecosystem smoother and easier for both founders and investors. If we can help you, come and see us. We'll distribute the recording hopefully later this week, if not early next. And we'll include some blog posts, materials, and a link to the ACA model convertible note. Thanks all. Thanks, Dror. Thanks, Gil. Thanks, David.
Gil. Thanks, everybody.
Yeah.